Hello, everyone. Welcome to the quarterly Rapaport Diamond Trends webinar. My name is Avi Kravitz. I greatly appreciate you joining us. I know your schedules are busy, and we've got an audience from around the world, and it seems a very diverse audience as well. And the idea is to get, as always, to get an idea of what's happening in the diamond market. We're approaching it's the end of the year now, and we've entered the holiday season. So now is as good a time as ever to discuss what's going on across the supply chain. And we've titled this webinar as Changes, Challenges, and Opportunities. And but really, we're going to focus on looking at what's happening in the market and trying to pick out what those changes are, where the challenges and opportunities lie. 2021 has been quite a year, as was 2020. 2020 was a year of crisis. 2021 has been a year of recovery, but also a year of significant change. And so I hope to talk through some of those changes today and get a sense of what's going on. So firstly, I want to just give a shout out to Shimon Gerstensang, who's the head of our pricing division at Rapaport, and really a lot of the ideas that we present in the webinars on an ongoing basis are a result of my discussions with him, and it's greatly appreciated. We also have on the call today our operations team, being David and Anna, and so hopefully we won't need too much technical assistance as we have in the past, but let's get started in the meantime. So I want to start off by just giving a sense of where we're at, a really quick run through of what's happening out there, and particularly in terms of the mood, because the mood is very positive, and that's a great thing. We've had a very good year as a generalization for the industry, and there's a sense of real optimism at the start of the holiday season for the retail sector. And we're seeing some momentum carry through among jewelers. And so that is trickling through to the rest of the supply chain. It's largely US demand that is driving a somewhat segmented, polished market. By segmented, I mean that certain categories are doing well and certain categories are doing less well. But it certainly will, as we'll discuss, those US type of goods that really seem to, and the US demand in general, that is driving the optimism in the market, driving orders ahead of the holiday season. And in light of that, we're seeing that polished prices are fairly stable and firm for goods above 1 carat, and the smaller goods, which are less prevalent or less influenced by the United States, seem to be softening, and then we run into some anomalies in the market at the moment as well. That there's a rising polished inventory, but there's also talk about shortages, and so we need to understand where those shortages are, why there's shortages, but also almost record inventory record number of goods that we're seeing on RapNet, for example. And then we take a look at the rough market as well. That on the one hand seems to be fairly controlled, but also we're hearing rumblings again that rough prices are becoming maybe unsustainable, or at least having an influence on polished prices, that manufacturers might be hesitant to reduce their polished prices because of the high cost of the rough that they need to buy to sustain their factories. So that's kind of, in a nutshell, what I'm picking up in terms of the dynamic of the market and the general mood. But overall, I would say the positives outweigh the negatives, and we enter the holiday season with an optimism that we haven't seen in a long time, and that's very encouraging. So looking at the retail side of things, and going into a bit more depth on each of those areas of the supply chain, we're seeing very good numbers at retail, and at least, you know, from within our news feed on diamonds.net, we're seeing positive growth in jewelry sales. MasterCard Spending Pulse, which is a source that I like to bring in these webinars, continues to see strong double-digit growth, not only against last year but the year before as well, in 2019. So we just got the October results for jewelry sales through the MasterCard system, and it showed for October 40% increase over last year and 39% over 2019. So it's that momentum is picking up now, is continuing, and we're also heading into a stage now where we are not necessarily comparing to low COVID numbers. You know, we can understand the growth in April compared to April last year, because April last year everything shut down, and so there was going to be growth anyway. But now towards the fourth quarter in 2020, things were already back open, and there was a decent holiday season in the jewelry market, and so the comparisons are maybe more fair now, and maybe that's also why we're seeing a bit more reasonable growth, you know, at 40% compared to 200 and a triple or quadruple growth over last year, which we saw in sort of April, May, June. But either way, the numbers are encouraging from MasterCard, and we see that in our news feed as well. And these stories were taken from just this week. And yeah, from the earliest is the 14th of November, and these are the headlines that we're running on our news feed about retail. That I don't have to read them all out to you, but US jewelry sales to get Thanksgiving boost. There's a strong outlook for Thanksgiving weekend. US retail sales jump in the early start to the holiday season. Companies like Brilliant Earth, Richmond, which owns Cartier, all reporting very strong growth in the third quarter, the most recent quarter. And in general, the luxury market seems to be set for a rebound. And this isn't us saying it. It's either company reports that are giving us this information, or research, outside third-party research that we're reporting about. But as I said, the general message is a positive one. And we're seeing it also in the share performance, in the stock market. Those jewelry companies that are listed in the United States, being Signet Jewelers, and most recently Brilliant Earth, which is Brilliant Earth, for those who don't know, is a company that is very focused on sustainability, and that's their core message. And they IPO'd, they listed on the stock exchange in September. But if you look at the Signet Jewelers trajectory of that stock price, during COVID, during the shutdown in March, April, it was down to $5 or $6 a share, and in the last month, it's broken the $100 mark. And I think we can take that as a vote of a vote of investor confidence in the jewelry market. To some extent, it's also a much better run company than it was before. But overall, there is some confidence about jewelry sales that's translating to valuations of the jewelry market in general. And I think that's, to some extent, is feeding into these share price movements. Brilliant Earth, it's been 3 months. It's had a recent good run, and maybe it's too soon to show a sustainable or give an assessment of its overall projection. But it's had a good run in the last week, and so that again is encouraging. I don't think it's necessarily unrelated to what's happening at Signet. And so the momentum has continued as we start the holiday season. The holiday season, traditionally it's always been the Thanksgiving weekend that rings the bell for the holiday season. But really, we tend to look at November, the whole of November and December sales as an indication of how the holiday season went. And so we're well into it. And in addition to that, the holiday season has more companies are talking even pre-November as holiday sales. For example, Signet said in their last earnings report that they consider October already. They're seeing some holiday shoppers buying in October already, and so we're seeing some good momentum based on the previous slides for the holiday season, and that's feeding into that optimism. There are other factors that are the jewelry effect that in the end had a of the COVID situation to spend on discretionary items which they would have otherwise used for travel. And it was a period of emotional gifting that some people wanted to express their love for loved ones through a gift. And what better gift than a jewelry? It's a really accessible gift to give and fulfill that emotion. And so to some extent, and so I think there is a hangover of that, particularly on the second point, that there may be a conditioning of emotional gifting that people had during COVID, and that's continued. There is still a lack of travel. It's not where it used to be, although the travel industry is starting to pick up, I think, at least from what I can see. There are also supply chain issues that retail in general is dealing with, and the jewelry industry is experiencing it in a different way, and not as affected by supply shortages because of delivery delays, as say, for example, the electronics industry, or take your pick of what other industries are affected by those delays. Jewelry is generally delivered through air travel. A lot of the jewelers have did their inventory buying fairly early because they anticipated a potential supply glut in the diamond and jewelry market. And so those supply issues are not necessarily prevalent for jewelry, but the jewelry industry could again take advantage of that if there are shortages of product in other categories. People would maybe again shift to jewelry as an alternative. Where there is some concern about supply in the jewelry market is for online shopping and the ability to deliver on time. But again, that's more a organizational or bureaucratic thing that's happening across the retail sector. And then finally, I really think if you keep your eyes open, there's been a significant improvement in the industry's marketing capability, that we're seeing really effective campaigns by the Natural Diamond Council. De Beers just put out a new campaign, which was very different to what they've done in the past. It's called the well, they refer to it as I Do, and looking at and using the diamond is forever slogan in a newish way, which is quite interesting. And then we're seeing brands such as, you know, the usual suspects. Tiffany's doing some interesting stuff with their marketing, and others as well. I think that there is generally a understanding of how to navigate this new marketing landscape among jewelers and among the industry as a whole, and that's you know, through social media engagement and various other platforms, and that's very encouraging, and again feeding into the air of confidence maybe that the industry has at the moment. As I move to the next slide, I do see that one or two people have raised their hands, and there's maybe a comment in the Q&A. Feel free to put questions in the Q&A section, and we'll have some time at the end of the presentation to respond to those. Okay, so that's all good and well that we have some optimism in the market coming from retail, but what's happening on the polished side? And when we look at our flagship RAPI index, which covers the D to H color and IF to VS clarity range, and it's we take the top 10%, the average of the top 10% goods on RapNet to come to that index for 30 pointers, half carats, carats, and 3 carats. We see that there's been some good growth this year. It's been a positive year on the whole, but in the last few months there has been some slowdown in that growth, or maybe stability in some categories, in some sizes, and a decline, a softening of prices in others. So the softening, particularly in the 30 pointers and half caraters, and a slight decline in the 1 caraters, which is the black line, and continued growth in the 3 caraters. But if we focus on the half carat, 30 pointer, and 1 carat, there seems to be a bit of a turning point that we notice in the trend this year, and that happened around August. And so it's a question: what happened in August to that the upward trajectory sort of stopped or flattened, and in the smaller goods turned. And so I'm going to spend a bit of time trying to understand that what happened in, you know, what happened in terms of supply and demand in August that the price trend changed in 2021. But certainly in that first half of the year, we had really strong and nice price growth, particularly in those 1 caraters. So there are a few ways that we look at demand on RapNet. The first way is to see the level of searches on, you know, what are people looking for, how many people are looking, how many searches are taking place on RapNet. And it's been fairly, you know, it's within a range, let's say, across the various size categories and just, you know, in the 1 caraters, which is the top black line, we see a bit of a dip in August, which is where this vertical line is indicating, and I guess we can say that there was a bit of a peak in the searches, and there was a slight dip since then. But I wouldn't read too much into those searches. It's certainly within a range, and I would say that it's more more in the sort of stable zone than anything else. But maybe it does indicate that that demand was certainly not as strong as it was in that peak period towards the beginning of the year in the first quarter, where each size category had a little peak. And certainly it's kind of nice when you see these this consistency that in terms of the shape of the graph. Another way to look at demand is looking at the goods that were taken off RapNet. And we've said in the past that there are a number of reasons a company might take stones off RapNet. But if the way we look at it, that if the stone doesn't reappear within 3 months of being taken off, then we consider it a sale in some, or we assume that some transaction has taken place on that, and that some stone has changed hands, and so we are tracking that, and we see certainly in the half carats and 30 pointers. The 30 pointers is the blue line, half carats is the orange, and the 1 carat is the black line. That there was that the number of sales, and I really will say that in inverted commas, because it's not the only reason why inventory might leave RapNet, but the number of presumed sales peaked around April, May, and has slowly dropped and had a slight increase in the 30 pointers, but it's kind of stabilized through the rest of the year. The most recent data that we can present for this would be goods on that left the platform up to September. Because anything past that, we can't track that 3-month period and say with confidence that the diamond is off RapNet or has changed hands. When we look at demand, we consider the US market and the level of goods that are being imported to the United States. The United States, we know, is the largest market for diamonds and diamond jewelry. It's it accounts for up to 50% of diamond jewelry sales, and so it's the import data for the United States is a good indicator of what sort of demand is out there for that big market. And we've seen a consistent rise since the lows of the COVID shutdown, and reaching a small peak, I guess, from which is higher than, it's the highest since the second quarter of 2019. So it's kind of at a 2-year high in the third quarter, but it's been a fairly consistent rise, but not jumping in any way like we would have seen in 2018 in that second quarter over here, for example. So that on the demand side, it seems fairly consistent and nothing really out of the ordinary, I think, that might influence an increase or sharp movement in pricing. What I will say is that it seems consistent, and that's a positive. We want to see that when we talk about a decline in pricing that we showed or a potential decline in pricing that we showed in the RAPI graph, that we would have, if it was influenced by demand, we would have seen a sharp decline in demand, and we haven't seen that. And again, I think that's just filtering through from that the optimism and the steady and good sales that we're seeing at retail, that is filtering through retail. Jewelers are making orders. They're replenishing stock that they sold for what it's worth. So then again, thinking about that RAPI graph and the turning point in August, we look at the supply side of things. And when we look at and when we consider the total number of stones on RapNet, it's actually quite eye-opening that we're basically at record levels in terms of the number of stones on RapNet. We the dip over here was during COVID. You know, for various reasons, people took their stones off RapNet, but there's been a gradual increase again since then, and we are now well above. We're now above pre-COVID levels in terms of the number of stones that are on RapNet. And pre-COVID, we were already at a very high level of historic level of inventory on the platform. So that suggests that that supply is having an effect on pricing, particularly in the second half of the year, that we saw the flattening of that curve. But I think it is more nuanced than that. We need to look at it from a we know that there's so many different diamonds in the world that in different categories, that certain categories do well and others don't do as well at various times in their lifespan. And so what we're seeing here is that looking at the inventory on RapNet by size, and this is just looking at those RAPI categories, the D2H color, IF, VS, clarity goods, we're seeing that sharp increase in inventory on RapNet is really driven by the smaller goods, the 30 pointers and the half caraters, the 30 pointers being the red line and the orange being the half caraters. The 1 carat is more has been a more stable, slight increase, but it's pretty much in line with what we've seen throughout in the last year, really. And here we do see a nice little correlation that the increase in there has been a sudden burst of inventory of those, particularly the 30 pointers, but also the half caraters, from around August. Even before, in July, there was there's this jump in inventory there, and even before that, in the half caraters, there's been a gradual increase that continued through August, and you know, sometimes there's a delayed reaction in terms of the pricing as supply rises and has an impact on the prices. But I would say, I think we can say with some degree of confidence that particularly in the 30 pointers and the half caraters, where we saw that not a flattening of the curve, but a turnaround towards a decline of our RAPI index for polished prices, there is some correlation there. And this is just a reminder again. So if you look at the half caraters and 30 pointers, there, as inventory has increased in that second half of the year, we've seen a gradual decline in pricing of those 30 pointers and half caraters. In the 1 caraters, which is more of an American item, again, that the curve is flatter. It's there's more stability and support for those prices, and we see that stability or that consistency rather in the supply. so where's all this polish coming from? Obviously, it's coming from the rough market. Mining companies mine rough, and they sell the rough to manufacturers who manufacture it into polished, and it goes to the market as polished. And so we need to understand the level of supply in the polished market. We can look at the rough market, and the rough market is at times confusing as well, because here we see combined De Beers and Alrosa sales, both in terms of volume and in terms of value. So the volume is the bar graph, and we saw that spike in the first quarter, and then a bit of a drop in the second and third quarter, but still at well, let's say at normalized levels. When you look historically at the third quarter, it's the highest third quarter that we've had actually in terms of volumes. Between supplied by those two major companies, and I would say also in the second quarter, but it's still within that normalized range. The 1 carat is, and it's also that increased supply is still playing a bit of catch up from last year. There was an overhang of rough at the mining sector, and so that's been diminished now. That excess inventory among the miners has been shifted to the manufacturing sector, and so we can, looking at these numbers, we can gain some understanding of the increase in polished inventory, in polished inventory. But I think this is maybe a better indicator in terms of the rough imports to India have been fairly high in the second and third quarter. And we can see that in the third quarter, again, it was the highest since the second quarter of 2018, with 2-3 years, and so it's not too, and that's been the story in the last year, that since the fourth quarter of 2020, we've seen the spike in rough imports to India. India being the main manufacturing center and responsible for an estimated 90% of manufacturing rough into polished for the market. And so that's a very telling graph that and maybe gives us some indication of why there's this increase in polished inventory that we're seeing in the market as well. Because it's stemming from that manufacturing sector. Just anecdotally, it's not just a matter of the numbers. We are also hearing from the market, and particularly from the grading labs, that they have been seeing record submissions of goods for grading, for once they've been polished and manufactured, the manufacturers would send those goods for grading, and there have been record submissions for grading. Again, just an anecdotal indication that there's a lot of polished coming to the market, but we can't say that as a generalization. It seems that or at least what we're seeing on RapNet, that the excess inventory is in those smaller goods below 1 carat, 30 pointers, half carats, etc. And then when you look at the larger goods, 1 carat, 2 carat, 3 carat, there is a reasonable inventory out there. I don't think you would have those same concerns of excess supply for those goods. So looking at India, if India's importing all that rough, let's see what happened in terms of its polished output. That and I've done this by month rather than by quarter, because I think it's an interesting graph when you look at particularly what happened in October. In October, which last month, it's the most recent data that we have, we saw the spike, a really strong spike in polished exports out of India. Now, October is pre-Diwali, and over Diwali, which has just happened, just occurred early last week. So Indian suppliers want to get their goods out before Diwali, but even considering that and comparing to previous pre-Diwali supply, there seems to be a lot of India's exports really took a jump, and the orange. Sorry, I didn't label this graph with a. I didn't label this graph, but the orange bar is by quantity, the number of carats that have left that have been exported, and the blue graph is the value, and by both measures, there's a really strong tower over here that tells us that indicates that the trend is going to continue. There's going to be that increase in polished inventory has continued that momentum, and so there's still more goods coming into the market based on these numbers. So it's not going to necessarily slow down. Maybe it will slow down over the holiday season, but it doesn't look like there's any indication that it has. And certainly we are now back above pre-COVID levels. That in terms of both the trading, I think that's taking place, and also in terms of the inventory that's out there. But I stress again, what is the inventory, and where are those categories that are driving the inventory up? And so I mentioned earlier, now looking at the rough market and looking at the mining sector in particular, that there's been a shift in where the inventory is being held. And looking at, if we take mining production less their sales volume, all in carats, we see to what extent the mining companies have managed to reduce their inventory in 2021. There was a slight buildup in the 3 previous years. In 2020, not quite as high as I would have thought, and I think that's mainly because in that fourth quarter there was very strong rough sales, but the mining companies in 2021 really sold a lot more than they produced, and so it seems that the miners are in a position where they're selling what they produce, and that's very interesting because the rough market still seems to be quite strong, and we continue to hear about shortages in rough supply. And considering the polished inventory that's out there, that might be surprising, and it is a bit surprising as well. But it's a message that we continue to hear from the mining companies that there's demand. There's more demand than they're able to supply, at least in the last few months. This data is based on 6 companies: Alrosa, De Beers, Petra Diamonds, Lucara, Gem Diamonds, Mountain Province. Some have smaller production than others, but these are the companies that publish their production and sales data. So when we look at the rough market, we consider a number of things, and we wrote about this in the November issue of the Rapaport research report. For those who are subscribers, I would encourage you to read that report. But it seems that we're looking at lower production, a lower production bar, and I have spoken about this a number of times in recently, and also I wrote about it in the research report. 2020 certainly saw a drop in production, as for obvious reasons. Over COVID, there was some mines remain closed actually still. Others had to temporarily close, and affected production. And that came back to some extent in 2021. At the end of 2020, we also saw the closing of the Argyle mine, which takes off a lot of it takes off at least 10 million carats, which was its production last year, but in previous years it was much higher than that. And so the question is, are we entering a period now of lower rough production becoming available? There is a slight increase this year that compared to last year, as many of those mines have come back into full production. The blue, by the way, is the volume, and the orange is the value of production, according to mainly the Kimberley process, but also taking into account the company reports. Our estimate here is actually a bit above for 2020 is above the Kimberley process data, because looking at the company reports and the carats that they're reporting, there seems to be a bit more than the Kimberley process is accounting for. We need to look into that maybe more deeply. And De Beers also put out its number. Our number lies a bit, it's kind of in the middle of the Kimberley process and De Beers numbers. Anyway, it's a side point. I would expect maybe a slight increase next year in production. There are certain areas that are ramping up production. We're looking at Angola as an increasingly important source of rough, and they're expecting more that will maybe compensate for the loss of Argyle. Also, Zimbabwe's mine seem to up their forecast for next year, and so. But generally, I think the general consensus is that the rough production has peaked around 2017-18, and we're not going to get back to those levels, at least in terms of volume. In value is a different story, because value is driven also by price. And so that's where we are keeping an eye on things, particularly in the current market, that there is this feeling that rough price levels have been rising, and what effect will that have on manufacturing profitability and the prices at which manufacturers sell their polished, and what influence does the rough price have on the polished price is an interesting discussion that needs to be had. There are other things happening in the rough market. There's a change in the way rough is being distributed. The mining companies have been pushing the message of efficiency across the supply chain, again, sort of hinting to the fact that there's less rough that will come out of the ground moving forward, and so the industry needs to work in a more efficient way in order to get more out of the fewer carats that are coming out of the ground. And so there is a sort of push. There's a push that I think will accelerate in the coming years, where the miners are supplying according to demand. That's their wording, not mine. De Beers has been talking about this. They dividing its site holders into various categories and being manufacturers, dealers, and retailers who buy rough from De Beers, because each category has a different need. And so they want to supply according to that need, and certainly want to encourage, for example, manufacturers to manufacture and not flip its boxes and sell the rough forward. Other companies such as Lucara, through its Clara platform, are really trying to supply rough according to the polished outcome. And all this is in addition, technology is well, Clara is essentially a tech platform, but there are other examples where companies like Alrosa as well is using technology to really understand the yield and the potential polished for its rough supply. The second issue, the second change that's been happening for years, but is has taken another step this year, I think, in as De Beers continues to negotiate with Botswana government for a new deal, and that is the impact of beneficiation. Our understanding is that De Beers is supplying more of the larger rough, I think it was 2 carats and larger, to beneficiation countries such as Botswana and Namibia in particular. And so what the question arises, what effect does that have on manufacturing in India? De Beers is the biggest producer of those bigger goods. Not the only one, but it has a significant portion of the market. And so India is looking for support and rough supply from other sources for those larger goods. And so it's not only in manufacturing. Well, it is. And so how does that affect manufacturing in India? It's that it brings also fewer goods on the secondary market that many of the smaller manufacturers might rely on buying De Beers goods that have been that have come onto the secondary market. And so there are a lot of nuances, including the journey that a diamond takes now to get to come to market. So instead of being a rough being sent to India and polished there, and then going through its traditional distribution channels as polished, it's now in Gaborone and Windhoek, where what journey is that resulting polished from the beneficiation centers taking to the final? Is it going straight to the United States, going straight to Hong Kong? Is it going via Dubai, or via Antwerp or Israel or these other trading centers? Is Gaborone going to become a polished trading center in the same way it's become a rough trading center? That will take a bit more time and maybe is a bit more difficult to achieve, but that's where the polished is at the moment. That's where the greater portion of the polished is going to be. And so we need to think about that. So I think we have about 3 or 4 more slides, so just bear with me. I know there've been a lot of graphs and a lot to digest, but we'll open up to questions in 5 to 10 minutes. So the question is then, does the industry need more rough? At what price is it willing to pay for that rough? Are there shortages in the market in both the rough and the polished? What we hear in the polished is that yes, there's some people, despite the increase in inventory, there is it seems difficult to find goods for those in demand diamonds. And so it's not that there's a shortage, but again, there's a categorization of supply, and there's a categorization of demand as well at the moment, where the US, as we said, seems to be driving the market, and people want to sell to the US. The US is who is buying, and so there's greater competition for a narrower supply of goods, and it's difficult to find at the right price. And maybe that's the maybe that's the point that's being driven home, that the polished is out there, but prices have been inflated after that strong run in the latter towards the end of last year and through the first half of this year. And so it's difficult for dealers to buy. Never, dealers are buyers and sellers in the market, and so it's difficult for them to replace inventory that has been sold. And then again, the question is, to what extent is the rough supporting the polished? We spoke about the mining companies supplying rough according to the polished demand, which you would think is the correct dynamic, and it would be the correct dynamic. But then what is happening in pricing? Because it feels like the polished is now starting to chase the rough again. And so if rough costs are high, manufacturers would be less willing to reduce their polished pricing. And so we ask ourselves, to what extent are polished prices being supported by rough, because people can't reduce their prices, otherwise they'll lose on that stone. Maybe it's a side point to this slide, but we have been thinking about the geographical influence on pricing. That is, there's a price in America, and there's a price in India, and there's a price in Israel, and other centers, and they're not always in sync. India is a manufacturing center, and so you would expect that it's earlier in the supply chain and has and would have a bigger discount on its goods than the American market, which is then selling it on, has bought the goods and sold it on, is ready to sell it on. Also, the American market is willing to buy on credit. So if you're an Indian supplier or if you're an Israeli supplier, that are you willing to sell to the American market for a higher price, but give them terms and a period to pay off, give them credit, or are you willing to take accept a lower price for immediate payments? And so these are things that are influencing the market, and also influencing the bifurcation of the market, the segmentation of demand, let's say. So, for example, 1 and 2 carat and 3 carat goods are more of an American influenced category. Then it's maybe understandable that those goods are on a flatter tradition or more stable and firm trajectory in terms of pricing. Whereas on the smaller goods, the 30 pointers is less influenced by the United States. And when I say influence, the 1 carat is, or the 2 carat is at least, and to a slightly less extent, the 1 carat is, the 2 carat, America accounts for, by our estimates, about 50% of the 2 carat market in terms of B2B. And so you understand why it has that influence. India then has more of an influence on the smaller goods, and so as inventory rises, well, there's 2 things happening with that. The first is that the Indian manufacturer is closer to the rough, and therefore the rough price might be more of a factor when considering the pricing of those Indian influenced goods. And it's also China, by the way, that's strong in the 30 pointers and 50 pointers as the buyer, India being the supplier. But then also you're looking at the Indian supplier would be looking at the inventory levels and maybe be willing to reduce prices to keep turnover going. anyway, again, that's just something to think about in terms of the dynamics of the market. And so when we think about those changes, challenges, and opportunities, and how 2021 set a benchmark for the diamond trade, you're looking at a lower production in 2020, 2021 that might gradually increase, but not to the extent of pre-COVID levels, I think, in my opinion. Another, we mentioned the change in the rough distribution. And then, of course, technology has had its influence in changing the way we sell both within the trade, both polished and rough, and also how we sell to consumers. We've dealt with that at previous webinars, but it really was a sea change in the way the COVID was really a wake-up call for the industry in using technology to sell. And so that's a challenge a challenge and an opportunity, really. It's a change that's happened already. It's a challenge for those who haven't got on board with it, and it's an opportunity for anyone who wants to really sell diamonds and diamond jewelry in an effective and modern and dynamic way, and really engage with one's clients and the consumer ultimately. The other thing is the issue of social responsibility. Again, it's been the issue of sustainability and ESG, environmental, social, and governance issues, and how that fits into your business practice, and how that affects your supply and your relationship and your position within the supply chain. Is, again, it's a change that's been accelerated by COVID. It's really entrenched itself in the industry psyche in 2021. It's a challenge for those who are not thinking about these issues, and it's an opportunity for sure for the industry, because as De Beers focused on sustainability in its latest insight report, the industry is very well positioned to take advantage of this of the consumer desire for more sustainable product. And that report was the first time we've really had a confirmation from an extensive survey that consumers are willing to pay a premium for diamonds, diamond jewelry that is shown to be sustainably sourced. And that's something we need to think about and really not get left behind with it. And all that is, I think, feeding into this disintermediation of the industry and a general consolidation of the market. If you think about the industry becoming more efficient in the way the supply chain works, because of lower rough production, because of changes in the distribution, particularly because of technology and the impact that that's having on the supply chain, and also because of social responsibility. The bigger companies are going to want to source their goods from equally sustainable suppliers, and so is the market going to streamline into into companies and products that are kosher and those that are not? I think it will, and I think we will certainly start to see a greater proportion of the supply chain being marked as sustainable, because it needs to be. And so all that, as I said, feeds into a shift towards a more efficient supply chain. Just quickly, I'll run through as the last slide things to look out for in 2022, because we put that on the marketing for the webinar, and I don't want to leave you hanging. But I think we need to be cautious. It's a question how long the momentum is going to continue to the same extent. There are all sorts of factors that are fed into the optimism in the United States, the stimulus checks that households receive being one, and the jewelry industry being able to capitalize on the misfortune of other industries like travel, and also in terms, and I think we need to also look at the economic momentum in the United States. There's a real concern about inflation and the impact that might have on consumer confidence, etc. I think we are going to see in 2022 a normalization of trade, being that we will see we're already starting to see a return of traveling dealers, diamond dealers, going into the United States. The US market, for example, the New York dealer had less competition over the last 2 years because it didn't face the competition from those foreign dealers who would traditionally come in and sell direct to retailers. And so that, and they only had access to them online. As effective as it was, there's nothing like the personal touch in terms of sales. And so I think we're already seeing more foreign dealers traveling to the United States, and that's going to increase next year and be normalized. And I think we will have a return to the experience economy. I was fortunate enough to travel to the JCK show, and while the planes weren't full, they weren't necessarily empty, and people are certainly traveling both overseas and certainly domestic in the United States with greater confidence. And so they'll do so for that experience, that vacationing will return, and there probably will be a pent-up demand for it as well, as people are itching to get out there. I think we'll have a return to seasonal demand, the seasonality of demand, the seasonality of trading. We saw it come back a bit this year, but there were some delays. I think we'll see the shows return to their normal schedule, as we've already seen to start happen. And when we look at the seasonality of trading, we know that the first quarter is a quarter of replenishing inventory that was sold for the holiday season across all segments, from retail to polished to rough. And then it traditionally goes into a bit of a quiet period. And then there's the US Vegas shows, where people start to look at designs and collections for the holiday season again. And so I think that dynamic is going to return, and we didn't have that to some extent in the last two, well, certainly not in 2020, and also not to the full extent in 2021. And so what does that mean for supply? What does that mean for in terms of rough sales, in terms of polished trading, in terms of all that polished inventory that's come to the market, and how is that going to be affected? I think we'll continue to see the bifurcation of the market. I think you can maybe ignore the second clause of this point. It was not the point I wanted to make in this webinar. But that segmentation of demand, as we mentioned, across all various things from the previous slide, from that social responsibility player, those who are in technology, those who are not, etc. And then finally, as we mentioned, we're looking at a more efficient market. I think that drive towards efficiency is going to accelerate in 2022. I think the rough market will be interesting to see. I think you'll hear mining companies talk about selling rough according to demand, but we've got to keep an eye on pricing, if they and ensuring that rough pricing does not overextend itself, and stays in line with the polished market. We want the polished market to lead, not the other way around. And that impact of online selling, it's going to change again, and we've got to keep an eye on things and abreast of technology and tech trends, because the diamond and jewelry industry is not just about knowledge and appreciation of beautiful product that we have. It's also now as much about understanding how we can use technology to enhance the trading and buying and selling experience. So thank you for listening to me. I'm sorry I went over time a bit, but I will take some time now to look at to try and respond to some questions in the Q&A and also in the chat. There's a okay, so I'll start with the Q&As. Okay. So how do I think why rough prices are not growing, considering such a strong end user diamond jewelry demand and lack of inventories of a rough? There have been no major rough price hikes in the last 3 to 4 months, which is a bit counterintuitive if indeed there is a huge gap between the current supply and demand. I'm not sure I agree that there haven't been price increases in the last 3 to 4 months. I think we have seen that. In fact, I think from our, the mining companies don't publish when they increase prices, but it's a small industry, and we talk to people in the market, and our understanding is that even in the last site in November, De Beers raised prices on the cheaper goods, on the lower end goods. And that follows a series of increases in rough prices. So I'm actually a little worried about rough price hikes, and I would hope that there aren't any more. We went through a nice period towards the end of 2020 and the first half of 2021, where there was good profitability in manufacturing, and we've seen that wither away to some extent because rough prices have been upheld. Considering the trends that I showed you in the polished market, the question is at what point will the manufacturers stop or refuse to buy at current rough price levels? If they're telling us that they can't reduce polished prices because rough is too high, we need to keep an eye on rough prices, and certainly that tells us the opposite, that rough has overextended itself maybe in terms of its prices. The same question goes for polished. Why have they stopped increasing lately? Well, I think I spent a lot of time in this webinar trying to explain that and trying to give some theory as to why that has happened. Certainly in the just as a quick summary, we're looking at price declines in the 30 and 50, the smaller goods below 1 carat, but particularly the 30 pointers, the half carats, and at the same time we're seeing a sharp increase in supply of those goods, and so there's an oversupply of those smaller goods. The 1 carats, the 2 carats, they seem to be more stable, and there seems to be some balance between supply and demand in that. What was the inventory in 30 pointers and half carats in the past 5 years? The truth is it's up and down. From and that's just off the top of my head. I don't have the data in front of me, and to check and give a complete answer. But from what I recall, it fluctuates. It fluctuates. But I don't want to give you I can't give an exact answer there. If you want to email me and be in touch in private, I'll be happy to look at that data for you. Smaller size prices are softening and inventory is rising, what is the logic of the price increase in these sizes in this week's site? Great question. It's not one I can answer. It's a question I ask myself, frankly. It's a question I ask myself. So I think we do need to break it into qualities as well. That I did present an average which would span all colors and clarities. And so I think we do need to look at what categories of rough increased, and it's a very difficult exercise to link the rough to the polished category as a theoretical practice or an academic practice, but I think we can have some idea, and I think we would need to have a more in-depth look at that. What sizes were or what qualities, what categories of those smaller rough increased, and what's happening in the polished. It's something that I am happy to look into again in private if you want to work on that exercise with me, to the person who asked the question, and appreciate the question. These graphics are for natural diamonds. How are the CVD graphics compared to it? Can you say CVD is not spoiling natural cells? So, so I don't have the same data for lab-grown diamonds, but what we are, and I had this discussion with Shimon, and our conclusion was that that lab-grown is not having an impact on natural, particularly on the smaller goods as well, where we thought there would be a significant sort of what's the word, eating into the natural diamond market. But our conclusion was that we haven't actually seen that in a significant level yet. We are seeing more acceptance and more embracing of lab grown across retail and across and within the supply chain as well. More manufacturers, a lot of the larger manufacturers of natural are also doing lab grown, but we're seeing an increase in consumer sales as well, and those are trends that we need to keep an eye on. But it does, to me, it doesn't seem, it hasn't had a negative effect on natural diamond demand this year. If anything, this has been a banner year for the natural diamond industry, and that's it may have also been a banner year for lab grown, but our concern is the natural market, and the natural market's had a very good year, and it hasn't been affected by that increase in demand for lab grown. Okay, what proportion of polished trade do pre-owned diamonds account for? Is this supply sensitive to prices? It's a really good question that I don't want to venture to answer, because I don't know what proportion of polished trade do pre-owned diamonds account for. I don't have an answer to it. Is the supply sensitive to pricing? It is, as every and we are in the let's say recycled market. So we're buying we're all a lot of our auctions that Rapaport holds is our auctions are goods from the secondary market. When we look at estate jewelry and the estate market, that's a different story, and I think the pricing takes on a deeper level there, where we're looking at the provenance of the piece, the branding, etc. But it's a question I need to look more deep into. I'm sorry, I don't have a good answer for you. Okay, what is the current ratio of gem quality to industrial rough? How has it changed? Again, I apologize. It's data that we can look at, but I don't have it offhand. So the majority are, and certainly the value of the rough of supply is driven by gem quality. So the industrial market doesn't have a big impact on the wider market, and I don't think it would have changed too much. Maybe Argyle might have had a high percentage of industrial goods. I'm not sure. But again, I would need to look into that. No, apologies. Okay, so maybe we'll just take just 2 or 3 more questions. Okay, there's another one about looking at data for the last decade. What were the trends in prices of a 1 carat, 3 carat, 5 carat GVS in the past decade? Prices have not really moved. In fact, I believe not only we lost in real terms, but are nowhere near any other investment. Anything did better than our product, or that's more of a statement. Anything did better than our product. Well, I will say this, that we publish our annual report on pricing that gives that sort of historical data every January. So that's something to look out for. It's published in the Rapaport January edition of the magazine. And I don't have it offhand. I don't have that info offhand. So I don't want to again give out wrong information. You can be in touch with me in private. I can help you source that info. I will, and in that report in January, we compare investment grade diamonds. I think it compares a 1, 3, and 5 carats DIF to the performance of it in the Nasdaq and in of gold, of platinum, of various other asset classes. So it's something to look out for. And again, in private, you can reach out to me. Okay, what news am I hearing from the Chinese market, and any news from Japan? The Chinese market has become very domestic. Firstly, there's the tourist shopper that from China that has had an influence on on sales to consumers in various markets, including in the United States, particularly in places like Hong Kong, South Korea, etc. And so they haven't been active, and there's been a shift, both by, I think, because of COVID, but also because of government policy to emphasize domestic spending in China. From my understanding, when we look at the 30 pointers and the 50 pointers, which there's certain companies out of China that can have an influence on when they buy those goods on the market for those smaller goods. Our understanding is that they're not in the market as actively as they have been in the past, and that's why often we see that sort of fluctuation of pricing, of inventory, etc., of those 30 pointers, and so just from that, our understanding is that there's less buying going on, but it seems fairly stable. I'm not sure what the outlook for retail is for the holiday season. The holiday season, of course, includes a bit of Christmas, but it's more importantly the Chinese New Year, which occurs late January, early February. Okay. We are hearing that there is talk of opening the borders again in China, and that will change things a bit. Okay. All right. I'll take. Okay, we still have quite a few questions here. So I'm going to just pick and choose 1 or 2. Do you think the diamond shortage must be a result of the majors having purchased earlier this year? Do I see a future for trade shows? I do think that the majors I don't think the shortage is because of that. I think the shortage is maybe it's a the way I read it is that it's a shortage of having the right goods at the right price, and also because the demand has narrowed to some extent. I don't think it's because the majors purchased early. I agree with you. I believe it is true that the majors, like Signet, bought early. They made that point in their last earnings call that they foresaw a supply issues and made a point to buy early, and also because they wanted to be ready for an earlier season, which seems to be taking hold. But I don't think I don't think that's. I think they bought because they were worried about shortages, but I don't think those. I don't think they're the cause of the shortage. Okay, I think I've answered that question. Okay. Does ODC have beneficiation responsibilities in Botswana in the same way as De Beers does? ODC is the Okavango Diamond Company. Okavango receives 15% of Debswana's production. Debswana is the mining company in Botswana that's co-owned by the government and De Beers. And Okavango is a state-owned company that gets 15% of Debswana's rough for independent sales of De Beers. So it's a government-owned selling. It's a rough selling arm of the Botswana government, etc. Essentially, my understanding is that it doesn't have the same beneficiation responsibilities. In other words, its supply does not need to stay in Botswana for manufacturing. As far as I understand. If anyone wants to correct me on that, I'm happy to correct myself. But my understanding is that they can sell to foreign manufacturers who can export it the rough immediately for manufacturing. And in fact, quite interestingly, the Okavango is planning or has had its first auction in Dubai. So it's outside of Botswana, which I thought was quite an interesting development. That they are open to selling their goods in other markets, which is a change from previous policy. If lab grown is not impacting natural sales, does this mean the overall diamond market is growing by that much? In other words, growing by the combination of natural and the combination of the growth of natural and synthetics put together? I will say that it depends where you stand on the debate of that. Not everyone agrees that they're the same product and that they're the same market, although that's become more of the mainstream opinion. And so I would say that it doesn't really matter. Let's look at growing the natural diamond market. I think that's what I would advocate anyway. I think it is a different product. It's got a different place. The two products have different places in the jewelry market. I think we want to expand the jewelry market in general. And the strongest tool that the industry has is natural diamonds, because that's where the value lies. And so I think we can be very happy with the growth that the natural diamond market has had. It's a matter of math. If you want to combine that with the synthetics markets, by all means, it means that the category has increased. But I don't see them as one category, frankly. I still see them as I do see them as separate products, and I think it's becoming a bit of a danger. I would say a dangerous tendency for the industry to clump those products together, because when we consider the value that they both hold. Okay, sure. I think that's sorry, I just want to clarify, someone has commented here that since the beginning of 2021, the Okavango is entitled to 25% of Dipswana production. I will confirm that. I was actually under the impression that it was still 15, but I will relook at that. And just a final question, which I think is a very apt one. What is the time frame between rough mining and retail in the new, more efficient supply chain? Well, I don't have an exact measure of it, but I think it's becoming shorter. We are seeing, as I mentioned, the grading labs are seeing record submissions still. There's a longer turnaround at the GIA still in Mumbai, although I think it has improved a little bit over Diwali. But I think in general that's the idea, is to shorten that time from rough to retail. And I think there's interesting developments amongst various tech companies using AI for things like grading, using automated manufacturing, etc. That and we can debate that at another time, whether that's a good or a bad thing. But I think that it is that time frame is narrowing, and that's the point. That's where does your business how is your business going to navigate that dynamic as the distribution chain gets more efficient? And so with that, I wish everyone a wonderful holiday season, a successful holiday season from a business point of view, a healthy one from a personal point of view. And we'll see you again in January, February for our next webinar. And so thanks so much for joining us again. It's greatly appreciated. I hope you gained from this discussion. And if you have any questions, please feel free to contact me on the by email or hook or by crook. Okay. Thanks very much, everyone, and God bless. Have a great rest of the week.